Yeah, well, I think probably the highlight is that not only did we survive the pandemic as an association, we actually grew. So obviously, come March 2020, we were in the throes of planning for a Singapore conference, which we sadly had to cancel, and there was an existential question about what we do with ourselves. We moved up our webinar program. We took the time actually to focus on some of our initiatives, especially in the fintech area, our distribution, our DNI and TFDI in the origination and distribution space. It gave us a little bit of time out from the busy travel schedule to concentrate on those strategic projects, and we did those very well. But at the same time, we also grew the membership. So
diversification in culture is as important as it is in business. This is a solid foundation for ITFA as we emerge, change, and also develop. If you look at those type of member institutions that I mentioned earlier, you will see much diversity in the products, the techniques, the type of institutions, and also the geographical presence.
So the Market Practice Committee tries to understand what issues could impact our industry, and in particular the secondary market for trade finance, but also wider issues in trade finance that can have a repercussion on our activities on a daily basis. So some of that can be just understanding what's happening in the industry, what's happening from a regulatory perspective, trying to decipher some of these impacts, and looking at providing guidance to our members, trying to give some practical advice.
I would say that all of a sudden there was a lot more of a focus actually by people who would have never thought about this before. Where do things actually come from? How are they made? And how do they end up with me, right? And be that, for example, consumers, right? Who might have never bothered as much how the finished product ends with them. I'd say there's definitely been a lot of focus on that, and we still continue seeing that at the moment. I mean, I'm thinking about big industries such as the car industry, for example, at the moment really crippling with a lack of supply of chips, for example, and therefore there is demand, but actually there is no supply there.
And
I'd say
the Americas is an area where historically ITFA hasn't played too much, and conversely, the rest of the world is the area that the ITFA team weren't. So there was a real synergy to be gained from coming together. Many ITFA members are also ITFA members historically, and of course vice versa. So real opportunity to leverage their expertise locally, and in particular they're very heavily New York focused, but obviously throughout the entire rest of the continent. And it was a labour of love, I guess, coming together. A lot of legal work done, more taxation implications than we probably would have guessed at the start. But ultimately, we've got there.
Now, trade is still not completely digitized, but many things are progressing in the meantime. I think we have to distinguish what can be digitized without any need for policy change versus the specific instruments that require policy change of law, for instance, adoption of the model law for electronic transferable records, in order for digitization to be acceptable and those digital instruments to become enforceable. So that's really the major challenge, is that often the technology can't go far unless the policymakers take action. However, now we see this taking place, with many countries changing the laws in order to make digitization much more indeed widespread in their local market.
Yeah. So I would love to see, and maybe this is already there in the works, but I think what we need is everybody to know about it, if it is, a way of measuring that collective level activity and kind of gauging gauging things at the collective level. So as people are using the taxonomy, they're already going to be collecting tons of data and sharing it. There must be a way to collect all of that and then be able to have a look at, in real time to an extent, okay, lots and lots of people are doing this kind of thing that's having a big impact on land use pressure.
Yeah.
We need to not invest in so many of those for a while, and kind of maybe there's a technological solution there that somebody could really make a great impact by working on that.
Absolutely. It is, at the end of the day, it is a working capital play. It is about liquidity. If you can use the money of others, well, we'll use your own money. if it's at the right competitive rates. Let's be honest, return on capital employment, return on investment of many of these corporates is double digit in many occasions. Supply chain finance in itself, while you are supporting strategic suppliers with liquidity, it is not that expensive. It's a pretty competitive source of liquidity for your suppliers. And therefore, as a corporate, you can dedicate that money to run your business in more profitable areas.
I think the key word in the question is accelerated, because trade finance, supply chain finance industry was working on a number of digitization ideas, a number of digitization initiatives well before COVID. But after COVID, all these initiatives have become a necessity. In other words, COVID pressed the accelerate button, and there was absolutely no choice other than executing on these ideas and initiatives in terms of digitization.
It's somewhat paradoxical. You could argue that a money market fund, which is by definition a short-term investment vehicle, should be able to contribute to ESG. But the fact of the matter is it can, just like any other entity, it can send capital, it can direct capital to certain areas of the economy or indeed away from certain other areas. But the question, of course, is how do you measure that? How do you see where that is?
LIBOR's a financial benchmark. Benchmarks are really important. They provide transparency, they provide consistency, and they provide somewhere where we can coalesce and manage risk. And ultimately that reduces costs for people, which is a good thing in markets.
At the end of the day, the raw material for any kind of banking activity, but also for trade finance, is capital, liquidity, and credit related to capital. So it would depend what your institution is looking for and the restrictions that they have, if they have restrictions with leverage ratio or with liquidity, whatever. For instance, in ECA, we play very much in cover bond kind of a space because we are looking for long-term liquidity and we are not restricted by any kind of leverage ratio.
Well, nobody likes change. So when you negotiate these forms, you spend a lot of money to get this done. Therefore, by spending that and getting it exactly the way you want it, it's not easy to move somebody off of that position. So we're looking at the main problems are coming in with capacity being needed more and more. These deals are bigger and bigger. Not one insurer can provide that capacity, nor could one bank possibly fund this. So insurers are going to have to syndicate, and banks are going to have to participate.
So it was a big challenge in 2020. We had only done a few webinars. We did over 2020 and the beginning of 2021 around 60 webinars. Wow. So it was a fabulous output, and I'm really proud of us for having risen to the challenge.
Great. And I think just to end on that, I asked one question. What's the most important piece of advice you'd give to a woman thinking of starting a career in trade?
To be honest, I usually steer away from giving advice to women, simply because we are all so different. Our ambitions are different, our life aspirations are different, our family nucleus is very different. Yet, if I had to give advice, I would say, get yourself a good, or rather, a great degree. Study as much as you can and be prepared to be the very best that you can be. Hard work will be key. And however, when you are able to offer solutions, whether to your clients, to your colleagues, to your superiors, then you are more likely to get support. Believe in yourself and your independence. Truly embrace that you are the owner of your own destiny.
ITFA is now effectively the ITFA Americas regional chapter. Really good local functioning board. They've just had their first in-person event in September in New York City. First event in the last 18 months, and it's really been great to see the energy that they had in the room and hearing some of the stories of it. It brings back the ITFA's raison d'etre is networking and bringing people together, and that's what that's all about. So coming together enables them to leverage some of our scale and also give access to the global nature of the business.
Yeah.
And there's a couple of things we're doing as a rating agency. We've just launched a set of ESG scores, so standalone scores for corporates and for banks, which allow an investor to see the ESG risk profiles, the standalone ESG risk profile, as well as its traditional credit rating, of course, but the standalone ESG risk profile of an issuer, which we can then factor into the way that we're looking at money market funds to gauge the level of ESG awareness, let's say, in the fund.
LIBOR has been around for 30, 40 years, different stories of its origins, but sort of the late 60s it emerged in the syndicated lending market. And the idea being to have a benchmark or a reference rate that reflected banks' cost of funding. At that time, it reflected the interbank funding market. Now, what has happened in those 40 years, LIBOR has become very embedded in the financial system. We've seen it used across a whole range of products, much wider than it was intended, from mortgages to derivatives to lending products. But the markets on which it's based, and these benchmarks do need to be representative of those markets, is just not active anymore. Certainly since the global financial crisis, banks have moved away from funding in those interbank markets, and there's no longer sufficient transactions underpinning the market to support it. So the banks that provide the data aren't going to do that. LIBOR rates are going to cease for new use at the end of this year, so people need to make sure they're ready to move to alternatives, and they have plans in place for their legacy LIBOR exposure, and we're here to help with that.
So we look for more return of equity versus return of assets, as most of the Americans do, and in short-term trade, we play more like credit relief. Capital relief is tricky for low-density assets like the short-term trade finance. It can be done, but you have to fine-tune very much the structure and the pricing that you pay for the coupon. So it depends.